On May 6, 2010, at 2:32 in the afternoon, the United States stock market began to collapse. In 45 minutes, nearly $1 trillion of value evaporated. The Dow Jones fell 900 points. Procter & Gamble, one of the most stable companies in American history, lost 40% of its value in 4 minutes. Accenture, a company worth billions, briefly traded at 1 cent per share. Then, just as suddenly, it stopped. The market reversed. Almost everything recovered, and by the closing bell, most investors had no idea anything had happened. The official investigation took 5 months. The conclusion was strange and unsatisfying. It was not fraud. It was not a hack. It was not a human decision gone wrong. What happened was that a series of automated trading programs, each following its own logical rules, had interacted with each other in a way nobody had designed, nobody had predicted, and nobody been able to stop in real time. The machines had spooked each other into a panic, and the entire financial system had watched, helpless, for 45 minutes. That was 15 years ago. The machines have gotten considerably smarter since then. We are at a genuinely strange moment in financial history. Not because artificial intelligence is new to Wall Street, it has been creeping in for decades, but because the version of AI that arrived in the last 3 years is different in kind, not just in degree. And most people, even intelligent people who follow markets, do not fully understand what has changed, what it means for their money, and what the system now looks like from the inside. So let us build it from the ground up, because the story of AI on Wall Street is not really about technology. It is about power, about who gets to see the future first, and about what happens to everyone else when the answer to that question becomes increasingly not a person. To understand where we are, you need to understand where we started. For most of Wall Street's history, the edge belonged to humans, specifically to a certain kind of human, aggressive, well-connected, good under pressure, willing to work 18-hour days in a room full of people shouting. The trading floor was a physical place. It smelled of coffee and adrenaline. Information traveled by phone, by rumor, by gut feeling developed over years. In this world, the advantage was relational. You knew someone at a company. You had a contact at a government agency. You had a broker friend who could tell you what the big orders were before they hit the public market. This was not always legal. Sometimes it was. The line between information and insider information was blurry and often negotiated retroactively. Then, gradually through the 1980s and accelerating through the 1990s, something changed. The computers arrived. Not AI, not even close to AI, just computers. Fast, tireless, literal computers that could execute a trade in milliseconds and follow a simple rule set without flinching. Buy when the price drops to this level. Sell when it rises to that level. Hold for this long. These early quantitative funds, quant funds for short, were built on a simple insight. Markets are not perfectly rational, but they have patterns. And if you can find those patterns before anyone else does and act on them faster than any human can, you make money, consistently, quietly, without anyone on a trading floor needing to shout anything. Renaissance Technologies, founded by a former mathematics professor named Jim Simons, became the most famous of these. Its medallion fund has produced average annual returns of approximately 66% since 1988, 66% per year for 3.5 decades. The best investors in human history have managed maybe 25% annually over a career. Renaissance did not do this with better stock picks. They did it with better math. The fund famously hired physicists, cryptographers, and linguists, people who did not know or care about what a company made. They looked for signal in noise, and they found it, at a scale and consistency that remains, to this day, largely unexplained even by the people who built it. That was the first era, rules-based machines finding statistical edges and exploiting them faster than humans could. What came next was different. Around 2010, a new phrase started appearing in the strategy documents of major hedge funds and investment banks: machine learning. Not a computer following rules a human wrote, a computer writing its own rules after processing enormous amounts of data. You show the system millions of examples, you tell it the outcome you want, and you let it figure out the pattern by itself. The implications for finance were immediately obvious and almost immediately unsettling. Consider what a traditional analyst does. They read earnings reports, they study management decisions, they track consumer trends, they build a model, and based on all of that, they form a view about whether a company is worth more or less than its current price. This process takes weeks. It requires expertise. It's expensive. A machine learning system can read every earnings report ever filed, every management statement, every news article, every analyst note, every satellite image of a company's parking lot, every shipping and logistics signal, every credit card transaction data set that can legally be purchased. And it can do this continuously, in real time, for thousands of companies simultaneously. The parking lot thing is real, by the way. Hedge funds pay for satellite imagery of retail store parking lots to estimate foot traffic before the company releases its sales figures. What used to be private corporate knowledge is now reconstructible from space. By the time a company announces its quarterly earnings, sophisticated AI systems already have a better estimate of what those numbers will say than most of the people who work there. This is legal, most of it. The category is called alternative data, and it is now a billion-dollar industry. Companies collect and sell anonymized credit card transaction data, mobile phone location data showing retail visits, shipping and logistics signals, job posting data that reveals where companies are investing, web scraping data from pricing and inventory, and sentiment analysis from news and social media. Individual investors do not have access to most of this. The cost runs from tens of thousands to millions of dollars per year per data set. It's a market for information, and like all markets, access correlates almost perfectly with existing wealth. Now let's talk about speed, because this is where it gets almost philosophically strange. Modern high-frequency trading firms don't think in minutes or seconds. They think in microseconds. 1 microsecond is 1/1,000,000th of a second. Human reaction time is somewhere around 150,000 microseconds. In that gap, entire strategies play out. The fastest trading firms have physically located their servers as close as possible to stock exchange data centers, sometimes in the same building, sometimes in the same room. The practice is called co-location, and it's legal. The idea is simple. Data travels at the speed of light, and even that has a speed limit. Being physically closer means your signal arrives microseconds faster. Those microseconds at scale are worth hundreds of millions of dollars per year. One trading firm famously spent $300 million to lay a fiber optic cable in the straightest possible line between Chicago and New York, shaving a few milliseconds of transmission time. They later moved to microwave towers, which are even faster. The cable became obsolete before the ink dried on the contracts. This is not investing in any recognizable sense. This is financial physics, arbitrage at the edge of what the laws of nature permit. Most of this activity is invisible to regular investors. It happens in the spaces between the prices you see on your screen, in the tiny gaps between what a stock costs to buy and what it costs to sell, extracted consistently at enormous volume by machines that have no opinion about the companies they trade. Here's where the story shifts and the stakes start climbing. Everything described so far, The quant funds, the machine learning, the high-frequency trading, these are mostly systems that have been running in various forms, risky, complex, sometimes destabilizing, but understood, at least in outline. The new AI, the large language model AI, the generative AI that arrived publicly in late 2022 and accelerated aggressively since, is doing something qualitatively different. It's not just processing data faster, it's beginning to reason. Goldman Sachs uses it to replace junior analyst work. JP Morgan's internal AI tool is used by over 60,000 employees. Between 2000 and 2023, the number of equity traders at Goldman's New York office dropped from roughly 600 to approximately 3 humans. Everything else, automated. The same process is now moving into research, compliance, legal review, and risk management. Every cognitive task that follows a structured enough pattern is a candidate for replacement. Here is why this matters to you specifically. Your retirement savings, your pension, your index fund, they are all intertwined with these systems. When AI-driven trading creates volatility, your account feels it. And the uncomfortable math is this. If AI systems predict market movements better than humans and act on those predictions before you can, they are extracting value from the same market you are trying to profit from. Every dollar they make from a predictive edge is, in some accounting sense, a dollar a less informed participant did not make. Markets are not pools of money falling from the sky. They are mechanisms for transferring wealth between people with different information. If one class of participant has structurally better information and structurally faster execution, the math over time is not neutral. Today, somewhere between 60 and 80% of daily U.S. stock market trading volume is generated by automated systems. Human decisions are now a minority of market activity. The price of a stock at any given moment reflects primarily what machines have decided it should be. AI has made markets faster and more efficient. Fraud is harder. Certain risks are caught earlier. These are real benefits. But the financial system was never just a technical mechanism. It was a social contract, built on the premise that the money you saved over 40 years would, when you needed it, be worth what you thought it was worth. What is being built now is a market that is more efficient in aggregate and less navigable for individuals. The machines do not know you are in there. And the question nobody is answering yet is whether a financial system running on machine logic at machine speed, optimized for machine metrics, can still honestly be described as serving human beings. Or whether we built the tool, let it grow, and somewhere quietly stopped being the ones holding the handle.